Good afternoon, everyone. Welcome back to the first weekly market review for the month of May. So today is the 5th of May, and as usual, I have with me Gerald. How are you, Gerald?
Very well. Went for my civic duties last Saturday with the Singapore election. But we are in the midst of a very busy reporting season. But at the same time, we are seeing the markets recovering. So that is good news for stock investors. And I'll share more of those in today's update.
Yes, indeed. Besides the voting that we have to do on the Singapore side, we also have quite a lot happening on the market. Last week, we had quite a good week on the global market front. We have some good earnings from the Magnificent Seven stocks, Apple, Amazon, Meta, and Microsoft. And of course, we also saw on Friday the non-farm payroll data, which was better than consensus estimates. And of course, the trade talks were still the main worry of the market right now, but that also seems to be de-escalating, so market recovered quite a bit. So I'll pass on to Gerald to go through some of this data with us.
Yeah. The usual disclaimer that today's sharing is for information purposes only and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. So we saw a further recovery in global stocks in the past week. Sunny mentioned one of the reasons earlier. There seems to be some progress in the trade talks, so that is helping to ease investor concerns. But at the same time, the economic data points coming out from the US has been fairly strong as well. So the S&P 500 now back to above 5,600 points with a 2.9% gain in the past week. STI back to 3,845 or within 5% of its all-time high. I mentioned a few strong economic data points earlier, and this is what we see in terms of the US jobs data, close to 180K in the month. So that is actually above market expectations and helping to ease concerns about a US recession. At the same time, investor concerns about a potential stagflation or low growth and high inflation appears to be eased for now. We see this from the core US PCE price index change, where on a month-on-month basis, it was unchanged. And that actually represents the first time that has been so over the past 12 months. So in terms of the US government bond yields, we continue to see volatility, but at least for now, it is below the previous peak, where it reached close to 4.5% shortly after the announcement of the US trade tariff. In terms of the top performance for the STI, we saw a number of the Jardine-related names doing fairly well. So DFI Retail Group up by 6%, Hong Kong Land 6%, Jardine Matheson 4%. Okay, Yangzijiang Shipbuilding also up by 2%, with easing concerns around how they will be impacted if the US were to impose taxes on China-built ships actually going to the US. Okay, in terms of the worst performers, we have got CapitaLand Investment. The stock went XD last week. At the same time, the company reported lower revenue for the first quarter. So both of it is dragging the share price of CapitaLand Investment. Okay, so today I'm going to talk about two stocks. One is Mapletree Industrial Trust. The next is CapitaLand Ascendas REIT. What we see for Mapletree Industrial Trust here is that the share price came off with the concerns around the trade tariff and the spike in the US government bond yields, but has since recovered partly to now about $2.02 as of last Friday. If I were to look at the most recent earnings report, actually the DPU remained unchanged compared to the previous year at 3.36 cents. Okay, if I were to look at the revenue, it was down slightly by about 0.5%. Net property income down by about 0.5%. So fairly stable in terms of the net property income as well as the distribution to unit holders. Okay, so what this means for the full year of FY 2425, which is the 12 months ending March 2025, is that the DPU is at 13.57 cents, which actually still grew 1% compared to the previous year. If I were to look at the occupancy rate of Mapletree Industrial Trust, overall portfolio occupancy rate of 91.6%, down slightly from the previous quarter. Where the occupancy rate would be slightly weaker or came down compared to the previous quarter would be mainly data center, now at about 89.9% occupancy compared to 91.6% in the previous quarter, and business park 80.4%, still remaining one of the lowest occupancy rate across all its segments. On the more positive side, they continue to be able to earn positive rental reversions. What we see here is that for most of the exposure in Singapore, the rental rate that they were able to get in the first quarter on renewal were actually higher than what it was before renewal. Okay, so on average, the portfolio weighted average rental reversion was 8.1%. So that is continuing to help the net property income. Balance sheet of Mapletree Industrial Trust, the aggregate leverage ratio now about 40.1%, inching up slightly from 39.8% as of 31st December 2024. Okay, so if I were to look at the valuation of Mapletree Industrial Trust now, with the fall in share price now at about 1.1 times price to book, in line with the historical average, given that it's been able to maintain its dividend per unit while the share price has come off, the current dividend yield is above 6%, which is above the historical average as well as the sector average. Okay, next will be CapitaLand Ascendas REIT. It has also come off with the announcement of the trade tariff, but what we see here is that it's one of the more resilient REITs in terms of the share price performance, at about $2.66. So actually above where its 52-week low would be. Okay, in terms of the occupancy rate, we also see a decline in the occupancy rate of CapitaLand Ascendas REIT portfolio at about 91.5% compared to 92.8% in the previous quarter. Okay, this actually came down across most of its exposure, including in Singapore as well as in the US. Okay, if I were to look at the Singapore portfolio, the occupancy came down slightly to 91.6%. This was due to lower occupancy rate at Telepark, which is a data center. This is offset by the high occupancy rate at one of its industrial property as well as business space property. Okay, if I were to look at the portfolio as a whole, this is what we see where the occupancy rate 91.6% as of 31st March versus 92.5% as of 31st December 2024. If I were to look at the US market, likewise, the occupancy rate came down to 88% compared to 88.9% in the previous quarter. So quite similar to what we see for Mapletree Industrial Trust. And the lower occupancy rate is because of one logistics property as well as one business-based property where they saw lower occupancy rates. Okay, in terms of the rental reversions, this is where they have been able to continue enjoying strong positive rental reversions across the entire portfolio, 11% in the first quarter of 2025, compared to 8.6% in 4Q 2024. So stronger rental reversions compared to what we see for Mapletree Industrial Trust. Singapore, 7% rental reversions, US 10.3%, Australia 59%. Okay, and they've also given the guidance for rental reversions in FY 2025 to be in a positive mid-single digit range. Okay, in terms of the balance sheet, aggregate leverage 38.9%, so fairly healthy, below the 40% level, and interest coverage ratio of 3.6 times, unchanged from the previous quarter. What's also interesting to me here is that the weighted average all-in debt cost has come down to 3.6% compared to 3.7% in the previous quarter. Okay, CapitaLand Ascendas REIT has also been very active in terms of its capital management. So they completed one acquisition of a US logistics asset on 15th of Jan. They completed the redevelopment of one asset in Singapore and also two asset enhancement initiatives in the first quarter of 2025. Okay, the valuation of CapitaLand Ascendas REIT price to book of about 1.2 times, which is above the historical average. So it seems like investors are willing to pay more for the REITs, which are able to demonstrate more resilient performance. Dividend yield of about 5.7%, which is in line with the historical average. Okay, in terms of what to look out for this week, we continue to see a number of earnings report. For this week, we have got the banks reporting their earnings. So DBS on Thursday, that is definitely something that I'll keep a very close lookout for. A number of stocks actually going ex-dividend. And on the macro side, we have got the FOMC rate decision on Thursday, and investors are expecting that the Fed will keep interest rates unchanged in the upcoming meeting. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Gerald, for the updates on some of the REITs on the Singapore market. So as Gerald shared in his last slide, we are looking forward on the Singapore side, some of the key earnings, including some of the banks that will report this week on Thursday and Friday, DBS and OCBC. So just a recap, the three local banks actually covered or constitute more than 50% to 60% weightage of the STI index. So the earnings of DBS and OCBC this week will likely be closely watched and will likely be the main driver of where the STI will be heading this week. Okay, so as you can see that the STI index, we have sort of rebounded about 14% in the month of April since the low that we saw on the 9th or 10th of April over here due to the beginning of the trade war or the tariff war. So we have recovered the major drop. We had dropped about from the high of 4,005 points. We dropped about 632 points, about 15.8% drop. And we have recovered most of that already. And then we are up about 14.4% from the low that we saw on 9th of April. So where is STI going to hit next week? Largely depending on the bank's earnings, which a lot of analysts are still positive about it. So definitely that will be a key boost to the STI index. Looking at the indicators, you can see the MACD indicator, the momentum has been weak last week, but that could be because of the shorter trading week as well as some of the attention turning to the Singapore election. So sort of directionless in the past 4 or 5 trading sessions, I would say. But then again, we managed to broke above the blue and the amber line, which is the 50 days and the 100 days moving average. And that closing above those lines could mean that this could become the new support on the STI if we are able to see good results from DBS and OCBC. Okay, so this has now become the pivot level around the 3,820 points level. That is the pivot of the STI right now. Okay, looking at the other indicator, RSI, the reading is at 56. So this also means that there is a positive momentum in the STI index, although not really very strong momentum because it is still below the 60-point reading. But then it's still above 50. So that means that there's some positive momentum or weak positive momentum right now on the STI index. So STI will likely have some momentum to push up slightly further, especially if we get a positive results from the local bank's earnings. And then we could be sort of charging towards the high of 4,000 points again, the high that we saw on 28th of March. So I'm keeping a close eyes on the bank's earnings, and that could be that could really direct where the STI will hit. But definitely, if we push up further, the first resistance would be the double top that you see over here in the February period around the 3,949 points level, 3,950, I would say, before we start to push towards the 4,000 points earnings. Okay, so those are the two key resistance level to watch. The support is around the 3,820 points level on the STI. Next, let me move to the US indices, which also recovered well last week on some of the major tech earnings, as well as the fantastic non-farm payroll data and the de-escalation of the trade war, the tariff war, where US is actively reaching out to China, and China is now evaluating how it is going to sort of hold a discussion with the US. But as of now, a lot of news reports are still saying that there is still no trade talks going on right now, okay? But China is open to one. Okay, so Dow Jones, as you can see, we peaked somewhere around the end of January at the high of 45,073 points, and then we had a major drop of around 18%. We managed to avoid the 20% bear market, and hence we have rebounded from there, which is the low on 7th of April, and rebounded up about 13% from that 7th of April low. Okay, so the Dow Jones index, no coincidence, is now being sort of a stop at around the 50 days moving average, which is around the 41,288 points level. Last Friday closing of 41,317 is just slightly above that. And then the next resistance level that will be closely watched will be the red line that you see here, and that will be the long-term moving average at the 200 days moving average of 42,222 points. Okay, indicator-wise, we still have a very strong reading from the MACD indicator, signaling that the uptrend will likely move up further, and also the RSI indicator now at the 56-point reading, although not as a strong reading as a 60-point. But if you look at the trajectory of the the RSI moving, as well as the 14 days RSI moving average, both seems to be trending upwards, and that continues to show that the uptrend momentum would likely persist further, at least until we reach the 200 days moving average at 42,222 points for the Dow Jones index. Next, let us move to the S&P 500. So the key thing to note about the S&P 500, since the beginning of April, which is right here, 2nd of April, the announcement of the tariffs from US, last Friday closing at the level of 5,686 points has actually breached above the 2nd of April high already. And that means that the S&P 500, the broad index of the US, has already recovered all the April losses as of now, okay? And we are also very close to the 200 days moving average at 5,746 points. So this recovery also signifies that we have recovered about close to 18% of the 21% drop that we've seen since the high on 19th of February. Indicator-wise, MACD indicator showing very strong positive momentum. RSI is at 59 points, close to the 60-point mark, which signifies that the momentum is actually pretty strong right now, and hence the uptrend will likely continue. So with both indicators reading, there's a very high chance that the S&P 500 momentum can carry it up above the 200 days moving average of 5,746, and thereby forming the support level for the S&P 500 going forward to retest maybe the high that we saw in February at 6,147 points. And just below that, if you can see over here, that is the November high of the 5,000 or 6,012 points. That will be the first resistance level, which is the 6,000 handle, before we test the 6,147 point high in February. Okay, that is the broad index S&P 500. Lastly, the index that performed the best for the previous week due to the big tech earnings, due to the four names of the Magnificent Four performing well, that is the Nasdaq Composite Index, the tech-heavy index. So the tech-heavy index actually peaked in the December period at 20,204 points, and then actually it dropped into bear market territory, a drop of 26% to the low of about 10,784 points on the 7th of April. Okay. So the recovery of Nasdaq Composite was also quite remarkable. Within that same month in April, we have recovered more than 20%, close to a 23% over here, as you can see. And we have also breached above the 50 days moving average and now going towards the 18,000 level, which is where the 200 days moving average is at 18,317 points. Okay. Last Friday closing at 7,977 points is just 30 points away from the 18,000 level. And that could mean that it could, if we break above this level, similar to the S&P 500, the long-term moving average at 18,317 points would be the new support level for the Nasdaq Composite Index. Indicator-wise, it is also supporting that theory because the MACD is showing very strong momentum right now with no sign of that uptrend momentum subsiding. And with the trajectory of the MACD line and the signal line going to cross above the 0-point neutral line, if both cross above that level, that could also signify a acceleration in the uptrend going forward. On the RSI, we have touched the 60-point level. That is the most healthy reading that we can see among the 3 US indices. And that means that the recovery momentum, the rebound momentum that we see right now is pretty strong and will likely continue. And we still have some headroom before we touch the 70-point overbought level. So things are looking good on the 3 US indices, and some of the key earnings this week on the US side will also help support the index going forward on top of the data that we saw last Friday, the non-farm payroll data that was above analyst consensus, above market expectations. So key data this week for the US will be the FOMC interest rate decision. So above about 3% say that there will be a cut, but 97% of them is still indicating that we will likely see no cut for the month of May. So a lot of it will be depending on the narrative or what the comments of the Fed chair will say, and that will help us detect the market or also help to sort of give us a preview of what the Fed views the US economy is likely to track going forward. Okay, and that's all for me today. Anything else to add, Gerald?
Yes, apart from the US FOMC, like I mentioned earlier, I'll be keeping a very close lookout for the Singapore Bank's earnings, and I'll be providing an update on the Singapore Bank's earnings in next week's weekly market review.
All right, I think everyone is also looking forward to that. Hopefully, the tariff war will not impact the bank earnings that much, and we look forward to more net interest earning income from the banks, which contribute about 2/3 of their earnings for the banks. Okay, so that's all the time that we have for today. So do stay tuned to our next weekly market review on Monday. And in the meantime, trade safe and stay safe, and we'll see you in the next weekly market review. Goodbye.